one of the things I've always been concerned of for a lot of years is just the U.S.'s standing status as the world's reserve currency, keeping that alive. That's a when we talk about inflation, there's a lot of different possible things that can move prices, and we saw actually that there's a lot of pressures from government spending, to the monetary policy that was going on. And then you also have this euro, they call it a euro dollar. Euro dollar is a dollar held, it's a foreign currency held in a domestic bank. It's not the euro. A euro dollar is, so like a US dollar in a Swiss bank is called a euro dollar. But it's basically another word for reserve, a type of reserve currency that banks use to offset, movements in their own currency. We'll talk about that. With the US being the most foreign banks holding US dollars as a primary reserve currency. So just think if they all dump that, then there's a big supply of US dollars and pushes the value of US dollar down, means inflation goes up. So that's the risk. That would be a big one. Okay, so we got this going. Shoot, 1 second, folks. Let me run to my office real quick. I'll be right back. 2 seconds. All right, so you all signed in? You didn't sign in? Okay, so go ahead and scan in. Okay, so let's see here. Dun, dun. Find I created, oh, you know what? Oh, I did this on another computer. Let me, I'm so sorry. I brought another computer to work yesterday, I realized, and so I'll have to see if I can pull it off of Wolf Den. I'm gonna try to post this on everybody's, on all of my class sites here, lecture today. Investment, yeah, it's on your Wolf Den as a reading. But remember we talked the ASAD model, we talked business cycles, right? And so one of the things that I was wanting to do is to look through some of the different channels and actually just explore some of the channels in the aggregate demand. One of them, remember, C plus I plus G plus net exports, right? And so looking at the investment channel and looking very specifically today, I wanted to look at the cycles that investment goes through different as related to the business cycle. So when I talk about the business cycle, remember I'm talking about periods of GDP growth and GDP contraction, right? And so investment being a component of this GDP and just really looking at the cyclical component of investment. So I prepared few things here in this reading, and I'll just go through this reading actually with you. If my computer will click. You see that? Click. Oh, there it goes. It's just so slow. I'm sorry. Okay. Okay, so I can pull this up on the main screen. I need to share my screen with my Zoom folk here. Okay, so let me give you all just let me give everybody here. Let's do a thing about graph interpretation this morning. this is a skill that every economist should be very grounded in. And so let me give you all a chance, okay? Every time we should put up a graph, I'm gonna maybe ask somebody to just interpret the graph or just tell me about it. And so when you interpret a graph, you should always start by first defining the series. So what's this the data of? You know. Secondly, you should tell me what are the axes. So you can and try to build this in. So the axes, the x-axis, the y-axis. Okay. And then you should finish your interpretation with some sort of a pattern. Okay, to complete a story. So someone give it a shot. Your chance to be. I've given a lot of talks around the whole world. Okay, and about a million countries, but a lot of different countries about my research work, and I always have a graph to tell an audience of economists. And so this is something that is a skill. Go ahead.
So the x-axis is the years.
Make it in a story.
Story.
Yeah, you're telling a story to somebody. So start off with this is a graph of
It's the graph of the rate mortgage, the 30-year average in the U.S. It also shows the market yield on U.S. Treasury securities. Constant maturity.
yeah,
10-year Treasury constant maturity minus 3-month Treasury constant maturity and
from
1960. 1960.
you can kind of ballpark it.
1960 to 2020, and shows the percentages of each of the rates and of the blue red one.
The blue and red. Okay. You're doing great. You're doing great. You use the names. Blue and red.
Okay. So the 30-year fixed rate mortgage and the market yield on U.S. Treasury both went down at that's 1992-ish, I guess.
92. 92.
That's 80.
You looking about here?
Yeah.
80.
82-ish.
They reached the peak,
They reached the peak and then they just declined.
declined, and you're doing excellent. Decline from 1980 to 2020. There's a decline. It's great. Hey, excellent. That was excellent. So y'all see that right here? That was really great. And you keep working on it. You're telling a story. That you are on an awesome track there. It took me a lot of years of telling data stories to get sharp at it. And actually, the power that you get is when you get into a managerial position, you can take a graph and pull out the big picture and then explain it to people. And that becomes powerful because then you're telling stories using data. So, yeah, so we see a peak happen in interest rates. 30-year fixed mortgage average. This is, typically people getting mortgages. You know that there's a fixed and a variable interest rate. You don't know about this difference? Yes, no. I need some feedback real quick. No, anybody know? I say fixed variable. Okay, so when you get a mortgage or any type of a loan, you can have it structured as a fixed or variable interest rate. In other words, when you take the loan, you can lock in a certain fixed rate for the duration of the loan. So you'll always pay that rate. Or the rate can be variable, meaning that it'll change as the market rates change. Typically, they'll peg the interest rate that you pay to a common rate such as LIBOR, London Interbank Offer Rate, something that's like a published rate, and it'll be some percentage movement with that one. Now, when you get a fixed rate, a lot of fixed rates, we're going to look at a lot of stories with fixed rates, but remember, you're locking in at a fixed rate. And so what are rates doing right now? Yeah, now you see at the very end, at the tail, they're starting to rise. That's a key thing that you all need to know. Now we're in a period of historic lows, and now we're starting to rise. That's one key thing for the exam, okay? I just said it. But I actually got real lucky. I locked in my mortgage right at the bottom with the 30-year fixed. That means I'm always going to be paying 2.8% interest rate on my house. And no matter how high the rates go. It's really great. The power of interest when you buy a house, so just to put it in perspective, my house cost at least 3 times, if not more, than my mother's house when she bought hers originally. She bought hers in a period of much higher interest rates. We both ended up actually paying the same mortgage. So the cost of my monthly payments is the same as hers. I got 3 times more of a house. See? It's interest rates going up really affect the payments. When you get into finance, you'll figure out how to calculate all that stuff. But you see that big trend, right? There's a lot of stories actually we'll talk about with interest rates, but now actually I want to stay a little focused and talk about the cyclical components. We're talking about the business cycle fluctuations. You see that the recessions being the bars, these gray bars going up and down, right? So can you see any kind of a pattern in interest rates? So one thing you see, I got 2 interest rates up here. I got this 30-year mortgage average for the house, and I also have this treasury security. It's a 10-year treasury security. Treasury security is a bond issued by the government. Now you all know what a bond is? It's an IOU. Okay, it's a piece of paper, right? It says, I promise. So think about this. This is just a straightforward bond. A straightforward bond is it's basically an IOU. Okay, it's a fancy paper for the government seal. It's an IOU, and you're going to buy it from me. I'm going to sell it to you for $1,000, and I'm going to give you this paper that says I owe you $1,100. See? So I'm going to pay you back $1,100, and you're going to give me I'm going to give you this bond in cash for $1,000. I'm going to pay you off payments, or just a lump sum of $1,100 in the future. Now the term on this is how long it's going to be to get paid back, and it's also you can structure payments in different ways. Here we have a 10-year constant maturity. Okay. 10-year meaning this is a 10-year bond, 10-year payment back kind of thing. Now, interest rates on different terms are also going to be slightly different. So when I say terms, you know what I'm talking about now? A 10-year mortgage, a 10-year bond. You also have like a 3-month bond, or you can have different maturities, right? So do you think the interest rate should be higher or lower for different maturities? What do you think? Like for a 10-year versus a 3-month, should it be higher, or should you require higher or lower?
Both.
You think so I'm going to give you this piece of paper. I got 2 pieces of paper. One I'll pay you back in 10 years, and one I'll pay you back in 3 months. Okay. Now this IOU, I say it's 1,000. You're going to buy it from. And I'm going to charge one person 1,100 and one person 1,050. I'll give them back 1,050. Should I give the higher rate the longer term or the shorter term? You think the longer, right? You think that there'd be a higher interest rate for the longer maturity than the shorter. Why might that be the case? Yeah, there's longer to pay off. And the example I just gave was a little bit poor in that I did a lump sum, 1,100 versus 1,050, right? But actually, when we actually look at the actual rate itself, you might think that the rate on a longer term bond would be higher than a shorter term because that rate is fixed. And in the longer run, interest rates could also rise, right? Right? If the market, so say I give you get a 2%, I give you a bond that has a 2% implied return. And now interest rates rise to 5%. this thing worth? Is much more or less? Less, right? Now you see, this is a key thing in finance. As interest rates rise, bond prices fall. As interest rates fall, bond prices rise. Because the rate of return on the bond becomes more or less attractive to the curve. See? And in the longer run, there's maybe more uncertainty about how interest rates might go. And so therefore, I need to compensate you a little bit more for that longer term uncertainty with a little bit more return. I gotta pay, typically, I gotta pay you a higher rate. Does that make sense? But now here's a puzzle. Does it kind of make sense? Because you're going to lock in this rate, right? I'm going to give you a bond and a locked in rate. Well, what happens if interest rates rise? That means that you could have taken that money and gotten a higher rate of return in the future. You see? Does it make sense? So this is where we get this green line. This green line is the 10-year Treasury minus the 3-year, the 3-month, the short, very short term. Okay. What do you notice about that? This is probably, like, it's been historically one of the most powerful indicators. What do you notice about, so do you understand what that green line is now? That's the rate on a 10-year minus the rate on a 3-month. First off, look, it's mostly positive, right? Which means that indeed the 10-year rate is on a, most of the time it's greater than the 3-month. That's not always positive. What do you notice about? Do you see the points where it's negative? What do you notice about the points where it's negative?
It's like, right, well, the bottom of the second, 2008.
Yeah. Hey, look at that. Look at that, folks. Right before every single one of these recessions, that thing goes negative. Not interesting. That's kind of interesting, right? What do you think's going on there? Puzzle. First off, look at now look at the interest rates on the 30-year. Now to sort of, now that's the puzzle. I'm going to start this off with a big puzzle. We're going to try to peel it back and solve this puzzle, all right? So do you all have the puzzle in mind? What I'm saying? That right before the recession, the 3-month is paying higher interest than the 10-year. Now, to sort of start to understand that a little more, let's look at the interest rates. What's happening to interest rates relative to the recession? So look at that 10-year constant maturity, that red line. Look at recessions. Look at the recessions. What do you notice? Any pattern with a 10-year in recessions? Any pattern whatsoever. It could be within the recession, it could be before the recession, it could be after the recession. Do you see any pattern there? Just stare at it. It's definitely, you see some fluctuations, right? You're seeing some fluctuations. I'll do it with the mouse. I don't have a pointer. Look, do you see that? So from the red, if I look at the interest rate from the start of the recession till the end, the start to the end, the start and the end, start and the end, right? Start and the end of the recession. Do you see that there's a drop? over that period, interest rates are falling. Now, why might interest rates fall? Well, it's part of this is because the government is trying to, so they're actually, they're influencing these interest rates, right? And they're pushing down interest rates. Why is that? Go ahead and take out a piece of paper. Go back to your ASAD model. Okay. Okay. This is good. It's going to just help you just to reiterate, hit the points again. Get out some paper, get out your ASAD model, draw up your model real quick. We're going to cast this into our model real fast, and we're going to solve this puzzle today. Puzzle of this. Your paper? My pencil. Okay. Maybe I should. Bring one to class next time. Okay. Draw your ASAP model. While you're drawing that, I'm going to go to Zoom and share this camera. Upside down camera. Side up camera. Hopefully all. So start your model. Make sure you label everything again. Always get in the habit of that. And put yourself in a long run equilibrium. Okay. Start off there. And now from here, let's say there's a recession. Actually, I can keep that. Say there's a recession. Say there's something that shocks aggregate demand that causes us to be somewhere over there. Okay. 1 to 2, leading to a recession. Remember, there's now real GDP is below potential. Okay. Now, why would the government be dropping interest rates? That's pretty clear now. Why would the government push down the interest rates in a recession? Huh? We're in a recession. What are they trying to do? Prices are already lower here. Price pressures are pushing down. There's a downward price pressure because the economy is contracted. Not to push down, not to put prices down. Lower interest rates would do what? How? On what? More loans to do what? How would this affect? How would this affect our model? Investment, yeah. Interest rates go so we'll think about interest rates channeling through this investment channel. Okay, so interest rates fall. The government sees that we're in a recession, and they try to. One of the things that they might try to do is combat it by dropping interest rates. Okay. So when they drop the interest rates, what they're trying to do is make investments more attractive and push investments out. Remember, AD is C plus I plus G plus net exports. And so with the interest, by dropping interest rates down, they're trying to push investment up. and shift aggregate demand back out to where it was before. Okay, that's the goal. So that's the government's playbook, okay? And it's a well-known playbook throughout history. It's a well-known policy tool. Everybody knows about it, right? And so as investors looking out into the future, you see that there's the interest rates, you see you're coming into a recession, you're feeling this like this momentum, the market's turning bearish, not bullish, it's turning bearish. And so what's your expectation then about future interest rates? Not rise again. No, like, so you're coming into a recession. So look at where this, so again, what's the puzzle? The puzzle is this inverted yield curve. Look, it's actually happening a good distance before the recession actually happens. You see that? It's signaling. And again, look at this. Here's our latest recession right there. Again, we had an inverted yield curve before COVID was ever a thing, okay? This was well before COVID. In fact, I'd like to find out the data that. I will look into that. That is interesting. That's got to be at the end of 19, maybe. Okay, a year probably before COVID hit. We had an inverted yield curve. So the technical name for when that goes negative is we have an inverted yield curve. Okay, I jumped off. So, you know that the government, if you start to feel more bearish, you're getting more pessimistic, you're starting to feel the market turn south. And what do you think the government's playbook is going to be? Drop interest rates. It's well known that that's the policy. It's well known that that's the objective. That's probably where they're going to turn, right? So looking out into the future, you see a lower interest rate. Out into the future. But currently, you would expect still interest rates to be higher. Is that right? So looking at before the recession versus after the recession, even like going out a distance, you see that the current rates are expected to be higher than the longer run rates. Right? This is called the this is part of a broad field of what's called rational expectations. Rational expectations means that people in the economy should be looking forward into their futures and then basing their current decisions on their expectations of their future. Basically, their expectations of the future matters. That's rational. You look into the future and you make plans. And so if you think that the interest rates are going to fall in the future, then the rates on those 10-year bonds falls below the 3-month. The short-term rates end up being higher than the long-term rates. Make sense? Yeah? That makes sense? All right, because so I've given you all a bunch of things right here. You see that the interest rates typically fall during these recessions, and that there's this big downward slope. You see the overall trend, the peak in the late 80s, and the gradual decline, and then you see the relative to the business cycle, and you see also how this affects these differences in short and long-term rates, with the biggest being this this negative yield curve, this inverted yield curve happening before. Let me show you all a yield curve. I said inverted yield curve. I never showed you what a yield curve is, okay? A yield curve is going to be a plot where you have maturity You have the rate. So here we got a 30-year, maybe a 30, a 10, maybe I'll call it a 1, maybe a 3-month, something like this, right? And typically you would expect the rate on these to be, you'd expect it to be something like this, positive, higher rates for longer maturities like we talked about, right? As we move into more bearish markets, the yield curve flips and starts to look downward sloping or flat. Flat or downward sloping. Flat would be it hits 0. Downward sloping means that the short-term rates are higher than the long-term rates. See, we got long-term minus short-term. So you're subtracting a bigger number from a smaller number, you get a negative number, right? You see? That's what I mean by an inverted yield curve. Yield flips like this, flat or inverted. And that's been one of the biggest telltale signs of every recession that we've had going forward. Now there's a little bit of a caveat to that. I'll give you some practical things. So I gave you this is a tool that's predicted all these recessions going back to the you see it all the way back to when it started. The first one, I guess, being in the early 1990s, right? It's been a pattern that's gone for a long time. But we have sort of an unusual circumstance right now, which is what? Do you all know? Huh? Just in terms of the pattern of interest rates. Look, we were up at this peak and we came all the way down. How far did this go? Here's 2%. Look how low interest rates had reached, right? What's the real interest rate? This is the nominal interest rate. What's the real interest rate? Final exam question, review. Out of your brain. Real interest rate is equal to the nominal interest rate minus the inflation rate. What's our current CPI? Ballpark. Another exam question. These are just becoming situationally aware of the world we live in now. What's the current CPI? I'll find out what it is today. It's somewhere around 8%, 7.5, 8%, something like that. 7.9%. Okay. So with 7.9%, we're 7.9% here. What about maybe there? This high? Follow it across. Dun, 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 dun. What's the real interest rate? Positive or negative? Draw it up. Real is equal, these are interest rates. The real is equal to the nominal interest rate minus inflation. Okay, the nominal interest rate here on a 10-year is what? We'll call it, we'll say that the 10-year is at 2.5. So we have 2.5 minus 7.9. Look at that. Positive or negative, folks? Negative. We have a negative real interest rate. What does that mean? Well, that means in practical terms, that means that lenders are paying you to borrow. Does that make any sense? I'll pay you to borrow money from me. Normally you lend money out to get money back. That's why you do it.
So that should bring the same CPI.
I use the CPI here. You could use other metrics. There's a lot of different, remember, there's a lot of different prices in the economy. So think about this. There's a lot of prices in the economy. The CPI are the prices that you and I typically pay for goods that we buy and sell, right? Or big goods that we buy. There's also producer price index, but we can also look at prices across the industries. We can look at prices in a million different ways. okay? But inflation's up, no matter how you cut it. No matter how you cut it, this thing's negative or zero, right? So this is kind of a strange anomaly. We're going to talk about a little bit more a little later, but right now I want you to see that does it make sense to push interest rates down lower? They're already negative. The real rate is already negative. You see? Does it make sense to push it lower? So if we're going into a recession, would we expect that rates would fall much lower? Maybe not, right? Because we're already at a zero bound. You see, there's like zero is like a bound where it's like, it doesn't make sense for this negative thing to be happening really. But yet we're here and you're not going to keep going. There's nowhere lower to go, you see? So if we're heading into a recession now, how much lower can rates go, right? Which, thinking back to this yield curve, remember, this is driven by people's expectations. Does that make sense? We talked about that. So it's driven by people's expectations. So if everybody knows that we're at this zero lower bound, then this predictor, this has been historically a predictor, this inverted yield curve may not signal the next recession. Okay? This is still very useful for a lot of economies that are not at a zero lower bound interest rate. And maybe perhaps for this economy, if we raise our interest rates up to a healthy level, which is what we're going to have to do to curb prices, interest rates have to come up. They have that. This is unhealthy in a lot of ways. This is sort of this is what we're going to call a liquidity trap. We'll talk about that. But we'll have to get interest rates up, and then eventually, at someday in the future, when you're looking at the market and interest rates are in real terms positive, then this inverted yield curve may be something to really consider looking at carefully every day, maybe in the Wall Street Journal. I'd say if you're really into business, get a copy of the Wall Street Journal, look at the yield curve every day. Look, is it inverted? Is it positive? As long as the real is positive, then that's valid, okay? And this has been a crystal ball. Pretty powerful one. You see a recession coming from a mile away. You see? That's pretty powerful, right? Giving you a couple indicators. First of all, you see investments drop. Remember? You see investments drop. In fact, maybe I showed that to the last class. Let me show it to you guys. I think I might have. I think I might not have gotten that far. Did we look at the pattern of investment? Let's look at this. Let's look at real investment. Gross private domestic investment. Again, before it, so you see the pattern here is that it's dropping well before recession's starting. You see how this is all kind of working and playing itself out? Let's go ahead and overlay this. I'm going to overlay, I'm going to add a line, and let's look at either one. We could look at mortgage. One other thing too, looking back at the interest rates. One thing we could say about the 30-year mortgage and the 10-year constant maturity is you see that they're kind of moving together. You see that? They're moving together, and the 30-year is higher than the 10 because of the yield curve, right? And also because of the risk profiles. That's another thing. We'll get into that in finance. So let's overlay this. And I'm gonna need to, it's on, so one thing You see it's all plotted down here because I've got percentages and I've got huge numbers on this side in the billions. So I need to, so you can actually, the cool thing, I can format this and I'm going to throw the mortgage, the 30-year, I'm going to stick it on a y-axis on the right side. So on the right side now I have the y-axis for percentage, and on the left y-axis I have the billions of dollars in investment, and now they can be overlaid so that you can see them. You see, they have to be on appropriate scales. So look at the peak investment. Investment started to fall here, and interest rates are also falling. You see, real investment in the economy was falling, and there was a response to that to drop interest rates. They're like, oh, investment's shrinking. We need to respond to this, drop our interest rates. And you see that as interest rates are dropping, investment is already dropping. There's this thing of momentum. There's momentum in an economy, a huge amount of momentum. Like a big, gigantic weight, a pendulum swinging around, right? And they're pushing on it with these interest rates, but the momentum is already moving. It's not going to just be like it's going to respond. So that's a key thing to look at, is that responses are slow. Eventually, interest rates are dropping and you see investment again rising. Now, a big question is in this whole story, folks, and I hope you're listening to this, is you really have to wonder what kind of investment was created. What was that investment? Look, interest rates. So here's 2000. Here's 2000. 2001 recession was what recession? What started that? Do y'all know? Nope, not 9/11. Close to 9/11, but not 9/11. It's called the dot-com recession. So in 2000, in the year 2000, I remember this, Y2K, you had the internet was emerging, was being seen as like the future. And so all these startups were coming up, and investors were just dumping floods of cash into any startup that was out there in internet space. If you started up a company then, you could make billions of dollars, or not billions then, millions of dollars, and not have sold a single thing. So there were a lot of companies out there that were making tons of cash from pulling tons of cash in from investors and not actually having any sales. And so you get this metric in the stock market called a price earnings ratio, which is the price of the stock. This is the price of the stock over the earnings. When this is high, this is called a PE ratio. When their PE ratio is high, that means that stocks have high prices relative to their earnings, which means they're fundamentally being kind of overvalued. You'd think that the valuation of a stock should be somehow tied to the earnings of the stock, right? So PE ratios were all out of whack in 2001, and they're out of whack today too. We saw that the stock market was exploding and yet our economy was contracting. Happened in the latest recession. If you notice that, we were in a big recession and yet stock prices are climbing. How the hell does that make any dang sense, right? From a fundamental standpoint, it makes no sense. When you actually look at the distortions, it makes sense. We'll talk about that. We can talk about that, okay? But here we had over-optimism fueling stock market price. It's called a bubble. A bubble is where you have an asset value of a certain amount, right? There's an asset value, a fundamental valuation, and then the actual price in the marketplace for that asset is well above fundamentals. So you get a departure of pricing and fundamentals, resulting in what's called an asset bubble. And then everybody wakes up one day and says, hey, oh my gosh, these things are overvalued. And everybody freaks out and they start selling stuff, and there's a huge sell-off. And the sell-off that happened was the dot-com bust in 2001. That was the first asset bubble price. Okay. So the asset bubble bursts. All the stocks in the whole market come down because everyone gets super bearish and pessimistic. The economy turns into a recession. The Federal Reserve responds by, they respond policy-wise, pushing interest rates down, trying to spur on investment to counter the recession. And where did people invest after 2001? What takes off? What asset? So what type of investment was really fueled after that 2001 burst? In the wake of that, after that, what happened? Anybody know? Anybody know? I'll give you a hint. It led to the 2008 crisis.
Houses, property.
Houses, yes, real estate took off. Boom. That's when the real estate market kicked in hyperdrive. Interest rates were dropping, okay? Making it more affordable. Like I said, the difference, is that a hand up? Interest rates were dropping. All right. In fact, we could look at, I don't know, we could look at house volumes, or you could look at it in a million different ways. Do you want to look at house prices, or look at house volumes or something like that? Let's go look at it. Let's edit the graph. It's fun, right? You can look at stuff. Let's look at house sales, home sales, or home prices. How that? Let's look at prices. Let's look at prices. Let's look at home prices. Let's look at the price index. So this is another price index for different geographies. We could look at California or the United States. I'm going to pick California because their real estate market has a lot more swings. So they go through a lot more, that they're much like when their cycles are more pronounced. Over here, we have cycles too, but they're a little bit more muted. My house went up by a good amount, but my friend's house in Seattle went up by like $1 million. They both go up or going up. His is like so the effect is more obvious in California. I'm gonna pick that one. Okay, it's down there again. This is looking at the index. Let's go ahead and put this. In fact, you know what? I might have too many lines. We might need to get rid of investment. I'm going to chunk out investment because it's going to mess up our axes. We'll go like this. And then I'm going to edit the graph. I'm going to put them on different axes again so we can see this. Let's put this on the left. So I'm going to put the home prices on the left. I got the mortgage on the right. You see 2001 dropping. And look at home prices. Home prices were starting to rise. And then after that, in the wake of 2001, woo, taking off. See that? Now, how is this of value to you? Let's see these patterns. Well, first off, what you're seeing is you can see that there are certain these sort of policies that are pushing investment. We're driving an asset bubble, right? So it's making you aware of the existence of bubbles, of asset bubbles. Asset bubbles meaning prices taking off above fundamentals. Which should make you aware that when you look into the market today, to look for bubbles. You see that there's a lot of stimulus in the economy. There's been a ton, trillions of stimulus. And there might be some price distortions because of that stimulus, right? So this gives you an insight to look. It's not going to probably be housing, right? Maybe, but try to always look at, gives you an idea. Look what happens. Investments falling, making housing more affordable. Housing responds by taking off. This investment cycle peaks right here and then starts to drop. Are you all interested to look at this yield curve again? When do you think the yield curve goes negative? So here's housing prices. Peaks in September 2006. When do you think the yield curve goes negative? You want to see? I'll go ahead and take off the interest rates and I'll add the yield curve. Let's look at 10-year minus 2-year. I'm gonna go 10-year minus 3 month. That's the typical one. There's also 10-year minus 2-year, but I'm gonna go this. And let's go ahead and edit lines. Edit line 1. I'm gonna junk this one. I'm gonna edit the graph format. I'm gonna put the house price on the right, yield curve on the left. Look at that. There's the housing price peaking. And it started to dip. That box is really annoying. I wish I wouldn't have that box. Oh, I don't care to see the box. Okay, you'll have to see it without me pointing at it. But do you see what I'm trying to find? I'm trying to look at where did it actually dip negative? And you see it started to flirt with negative territory as housing price was actually slowing down. And then right at the peak, is when it dipped negative. You see, there was a housing prices slowed. All the insiders are seeing this all being driven by housing investment. People that are knowledgeable about economics, knowledgeable about these things, are looking into the future, saying, "Oh, look, this bubble. We're starting to hit a bubble here." People start looking into the future, getting more bearish. Yield curve starting to drop, housing prices starting to drop. And as housing prices started to drop, people got upside down in their mortgages. So I had friends in the city category. They had bought 5 houses. They own 5 houses because everyone's buying houses and they're making tons of money buying them. Houses price goes up, you sell it, make a ton of cash. My friends make millions of dollars this way. Now, that's all great until housing prices start to fall. Then all of a sudden you're holding on to all these houses and you owe the bank more money than what your houses are worth. And if you sold it, you're going to go negative. That's called being upside down, right? And so you get more defaults. And there's a whole detailed explanation about how those defaults ended up destabilizing our financial system, leading to a 2008 recession, the big one. But can you appreciate the cycle now of investment and how it's played a role and how these cycles are relative and one of the main drivers to are recessions. These cycles of bubbles and bursts, asset bubbles. Y'all want to look at the stock prices since we're interested? And just looking at this, let's look at current assets let's look at, let's add a line. Let's look currently, let's look at stock. Let's look at the Dow Jones, how's that? Those are the big blue chip companies. Let's add this data series, let's see how that looks. Dow Jones. Where is that going to be? Why does that end in 1960? That's garbage. I wonder if there's a stock price index. Let's look at that. Okay, to 2000, no, I want the. Okay, I might need to go to a different site. I'll just go, let's go the S&P 500. There's the 1 day. Let's look at a 5-year. So here's COVID happening. You see, we had an initial drop, a sell-off. So that there's COVID and a sell-off, and then it's gone from the sell-off point of 23 up to a peak of 47, coming from a previous point of 3003, right? So stocks have grown actually by a ridiculous amount over this period. And that's not reflected in, and a lot of that growth happening during periods of economic contraction. How does that make any dang sense? Now you see that, look, what's happening there. Now prices are starting to fall. So stock prices are starting to correct. I mean, I would say that they're far above fundamentals. If we looked at things like PE ratios, like we could look at PE ratios. PE ratio. So we can find some data on that. PE ratio data. PE and yields. I wonder if that's going to give it to us. I want a graph. I don't want it just a snapshot. I want it over time. Look at this. PE ratios, 2008. Just going off the charts. Again, going off the charts. Here's the 2001 PE ratios. 2001 PE ratio spike. We have this 2008. Again, a lot of contraction in the economy, a lot of investment going in. We don't see that same contraction happening in the stock market. That's why PE ratios are flying off. And again, in the latest one, we see PE ratios being way above. And now we're starting to see some correction. If you notice now, the price index actually was starting to correct down. At the same time, the economy is growing. If we go back to the GDP figure, so if we look at like real GDP, it's going to squash all these into the axes, which is fine. Real GDP took a tank and started to recover, and now we're back to this recovery phase. You see? So on one hand, like our gross domestic product is recovering, but our stock markets were overvalued because of this, and they're all dipping. Now, hopefully, with a bubble, what you hope for is that the air from the bubble just slowly deflates, and hopefully, what we see is what I hope to see from a patriotic standpoint is I hope to see our stock market come down slowly, and not come down with a crash, but just kind of calm and kind of wind down and chug through some kind of periods of really just like substandard returns, maybe some minor losses. That would be okay by me, That's what needs to happen. Where we've got overinflated asset prices, you want to let that air out a little bit. At the same time, let the real economy kick back in. That's what would be healthy for us. That's one thing, okay? But I'll tell you what, like everybody in the news and all these other things, they all look at the stock price and that becomes the economy. And you just see that that's not the case. You know, economy, again, is about real production of things. It's about real earnings. It's not about stock prices. Stock prices are like going to the horse race and putting a bet on a horse. Sometimes those get overinflated, right? So we covered a lot about recessions. This has been like a little bit of a history. The patterns and the things that we talk about today, I'm going to throw in special questions to the exam. I put some questions here on Wolf Den for you in that reading, just so you know, like some of the, I might add to this list. But if you go again, and so those of you who are here, go to coursework, and then go down to, go down to ASAD model and investment. And then in the instructions, you'll see some of these things. I've also put a reading about, and this is just from Wikipedia, but here's some questions that I guarantee will be some of these on the exam, okay? That you have. Just can guarantee that. Just talking about overall trends, and I'll add to this, like I said. And there's also a reading about yield curves. So go ahead and look into that. There's different explanations about the yield curve. What I gave you was one about this is what's called a pure expectations kind of theory, an explanation. There's a lot of explanations that might explain the behavior of the yield curve, and I gave you one explanation. Okay, that's what I did today. Just to recap. You got a pure expectations theory, rational expectations, looking in the future. Okay. So I think we have, what is it, 10 minutes? About that? All right, so let's see here. So in the last 10 minutes, you guys also had a homework due, right? Do you have any questions about that? Anything anybody want to go over? Nothing from anybody? Okay. Let's look at just where we're at here real quick. So we have today ASAD model. We're going to jump into money, banks, and the Federal Reserve starting, I guess, Thursday. All right. So we're going to jump out of this. We're going to keep our ASAD model as a workhorse, though, just to look at some different events and put things through. And we're going to talk, eventually, we're going to talk, I guess, April 7th, we're going to go look at this savings and loan crisis. Specifically, that's looking back at so you remember the big interest rate peak? Saving and loan crisis was what was happening in that peak period. And we talked about it. You saw some videos about it in the Great Inflation. That's what's going to be there. So, so there's a reading for you. You might just jump into that early. If you have an article about money you want to talk about, maybe send it to me, and I'd be happy to try to frame it. You said you had one. I'd be happy to look. If you want to send it before like today or tomorrow, and give me a chance to just look at it, and maybe I can give you a better comment. If anyone has anything specific they just want me to like reflect on or bring into the conversation about money, about cryptocurrency, about anything related, like I don't know, any of y'all interested in that stuff? Crypto or money, and I know it's a popular thing. So if you have anything that you want me to just like try to weave into this content and reflect on, I'd be happy to weave it in, because that's where we're headed. Yeah, there's been everybody's familiar with cryptocurrency.
Yeah, it's on the rise right now. Everything's on the rise.
Everything's on the rise. Prices, right? Again, what we're talking about when we say things are on the rise, we're talking about relative prices. Relative to what? Relative to the dollar. The dollar. Inflation. Prices, okay? Price changes. So one thing that we'll need to reflect on for those of you who are into crypto is I want you to look at the functions of money. And that's what one thing we'll look at is what functions does money actually have in the economy? And I'm going to give you a little bit of a history of our development of the banking system. It's actually an incredible system when you think about it. These are incredible institutions that have helped us to develop our economy into a modern economy. Without them, I don't know that we'd actually be here. Even with all the science and everything else, we still need to have the money to get those ideas off the ground. It's like having the idea itself is worthless unless you can take that idea and turn it into a reality. And to do that, you need to have investment. You need to have access to large pools of cash, which I don't have in my pocket. Most of us don't have. And so if we don't have access to those kind of pools of cash, then the only people who can ever progress society forward are a very select few of people who have those kind of access to resources. You see? But the fact you can go out to a bank and get a loan to do something and to start something, this banking system, I just wanted you to reflect on that, on how powerful it is in driving the real investment in our economy going forward. So we're going to look at the history of banking, that some of the major things that happened, some of the major restructurings. We're going to look at money, the purpose, like what is actually money, what are the purposes it serves, and then we'll switch into looking at, eventually after that, we'll look at the policies that the government takes to try to influence the money supply to affect our recessions, our ASAD model kind of stuff when we're in these recessions, expansions that try to curb or promote price stability and employment. Remember the dual targets, the dual mandate. Okay, that's it. We'll just wrap it up there. 7 minutes to spare. Anyone have any questions? You're welcome to ask, or you can just we can just call it here. Oh yeah, sure.